What happened, dude? Like that shit was crazy. Like everything that happened last week, everyone was trying to like buy into this hype. But like I just want to get like,
Right.
your perspective on it because I know you were able to like give me some perspectives like offline that I was really interested about. So could you just like go into that in just like a
So
short into like
basically,
layman terms?
basically, there are these large financial institutions that basically said, okay, this is a diet, GameStop, BlackBerry, Nokia, AMC, the business model's dying. So let's
Mhm.
basically short the crap out of it and make money for our investors because, these companies, they have a responsibility to their investors to say, we're going to do whatever we can with the tools that are available within the legal system to maximize our returns. And shorting GameStop is one of them. And basically, the Redditors, the degenerate Redditors were like, there's a huge short interest on these companies. Why don't we start buying up shares like crazy, push the share price up? And what a lot of people don't realize is it actually costs money to short shares because you have to
Mhm.
borrow the shares.
Yeah.
And to lend the shares, there's a fee. And that fee is correlated with the circulating supply of outstanding shares. And as that supply decreases, the fees start to go up and up and up. And in a lot of cases, the people that are doing the shorting, if the price moves in the wrong direction enough, you actually end up having to cover your shorts, which means
Mhm.
buying the shares that you're actually being loaned, basically. And that actually that makes the circulating supply even smaller. And what it does is it pushes the growth curve like into a really parabolic mode and starts to drive the price really, really high, really, really quickly. And that's basically what happened with the whole GameStop situation. Because you had this massive pool of retail investors with massive short interest and already high fees because of the high short interest. So the short interest basically, the short fees jumped in the stratosphere, and then you have to now pay for the short fees. You have to cover your position on the long side to cover your shorts, and it sort of just created this perfect storm for the stock price to like just essentially go into the stratosphere.
So can you just
So I don't know, like,
clarify? Wait, go ahead. Go first. Go first.
no, no. So I don't know investing too much. So like for those like retailers, do they have to take up all those fees, or is it mainly like all the hedge funds, or who took up those short fees?
So anyone who wants to short a stock, they have to pay a
Mhm.
fee. And
Oh, okay,
that
okay.
is that's like usually a black box calculation by computers that are using algorithms that most like 99.99% of the population cannot fathom. There's just so much data being fed into these things that actually in a lot of cases, the people who wrote the programs actually cannot verify how they're working themselves.
What? That's weird.
Because when you train a neural network to do like regression, for example, like
Mhm.
the way that that program is working is actually unverifiable to the person who wrote the program. They just feed in a bunch of data, train a model, and then that model is like, from a computational standpoint, unqueryable. Like you don't know what's going on. It's just spitting out numbers, and as long as you validate it, you basically are like, okay, this model is working. We'll put it into production.
So then how do you know that it's verified? So for example, is that like referring to like a machine learning type of algorithm or something like that? Like what is that?
Yeah, so the any tool that you build in machine learning goes through this testing phase. But one of the problems actually with a lot of machine learning models is they tend to confirm their own biases and actually rather quickly. So what ends up happening too on the electronic side is when they see the price of a stock that's not worth a lot jump that high, the electronic systems will actually try and take advantage of this and increase the short interest without human intervention. So it was just this massive perfect storm of things that just sort of created this chain dependency upon each other, and it just drove the price higher, 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 higher. And we'll talk about sort of the like consequences for the retail investor, and where I think a lot of people were irresponsible, like after the fact, or
Oh yeah,
sort of like the rise. And because yeah, we'll talk about that later. But like, any general questions about like what
exactly.
exactly happened?
So basically, you're saying these algorithms are basically what caused the prices to pump up because it had to when the price
They're
pumped up,
partly to
they like
blame, yeah.
shorted it. They shorted. They had to
Yeah,
short more
yeah, exactly. They
because the
act
algorithm
faster.
said short.
They act faster
What?
than any human, and then people
What?
they act faster than any human. So they're going to react the quickest, the fastest, and in most cases they'll have the best reaction because they can consume the most data and then make a decision using that data. So what that does is tells a lot of these retail investors, especially day traders, like momentum traders, swing traders, they get this data coming in saying, oh, holy shit, you know, the numbers on this are crazy. We're going to put money into the stock because we think we can make an easy 10% before the day is over and then pull our money out. And then you had people in the Reddit thread saying, no, you got to hold the line. You know, we're fucking over the big man. You know, this is an equity to the system. But like, what a lot of people don't realize is like, and hedge funds are they're not like innocent per se, but they sort of exist as like these third party like bystanders essentially that sort of watch what happens and then they take advantage of the system to make money for their investors. Like, they're not a lot of times actually they're the ones providing liquidity for people making like these degenerate bets. Like, if you want to buy a call option, the probability that a lot of the people on the other side are actually these market makers like Citadel, Jane Street. They're the ones allowing you to make all these crazy bets. And if they didn't exist, actually, the spreads on a lot of these call options or a lot of these stocks that people want to gamble on, they'd be massive. And actually, they would actually restrict a lot of investors from playing in, actually.
So a lot of like the things, the calls on like Robinhood, on like Webull, right? A lot of times
Yeah,
these are being sold by bigger companies because they're basically saying like, hey,
by
I
actually
think that
market making.
right, yeah, market makers. They're saying I don't think that the price is going to hit X point. So let's say GameStop will not hit $300, so they're selling that call option,
Exactly.
right?
Or they think it won't move past a certain point. So
Exactly.
they're able to hedge themselves and sort of make money on both sides, which is what market makers do. They have these electronic systems that price the instruments such that they think that they can make money uh, by essentially over time. They're taking advantage of the time value of money of these financial instruments.
Yeah. So let's backtrack here. Can you just explain in layman's terms what a call option is and what a put option is for
Yeah,
people that don't understand?
yeah, for basically it's a call option or a put option is essentially the same thing on either side of a trade. So a call option is a fixed price instrument that you can take in the expectation that the price of the underlying instrument will go up, and then the gains that you make uh, beyond the strike price, which is the original price that you paid for the instrument, those gains are actually multiplied by 100x, and then that's what you get to keep when it expires. Or what you can do is before the expiration date, sell it by buying back a put on the other side and essentially closing out your position for either more or less than what you originally paid for it. And that's how you sort of recoup some of your gains.
So then what's a practical example of that? So for example, let's just say,
So,
for example, you bought something for GameStop.
yeah, in the GameStop example, let's say something, the price is trading at 100, a price for a single contract is $15, and let's say the stock jumps to $120. Basically, the $15 is fixed because that's the price that you paid for the contract, and then the $5 in excess is your profit, and then that gets multiplied by 100, and then that's the money that you get to keep, minus any underlying decay of the contract itself. Basically, options, they go under what's called theta decay, which is essentially the time value of money of the instrument itself. And approximately speaking, half the time to expiration, you actually lose about 67% of the value of the underlying instrument. And that's both for calls and puts. Same
And for
thing.
puts. Okay.
Puts are on the other side.
Yeah.
So
So
did you learn this like in college, or did you kind of learn this from experience, like over time?
So I actually took a couple classes in quantitative finance when I was at Rutgers. So I was sort of in this space already, but not from a like investment finance like point of view. I knew the math, and I knew how a lot of these things like were transacted because I had friends who were in quantitative finance.
Mm-hmm.
And so when did you decide to like take that leap to invest in these things? Like, do you currently hold anything? Like when GameStop and all this stuff did happen, did you decide to run in the hype, or what did you decide to do as an investor yourself?
I sort of watched the whole thing unfold because it wasn't worth it to me necessarily to get involved. I did get involved, but not to the extent that people were like gambling like large sums of money on this, because the whole situation was like a real mess. And
Yeah.
I think what a lot of
Literally gambling
is that the state literally has the power to do anything. They can step in at any time, stop trading, halt trading, because they are privy to like a lot of the consequences that could happen if they let something continue. Like a lot of people don't realize like these people that are working at the SEC and the FTC, like they're extremely smart people. They understand like the consequences of these large financial institutions having to liquidate their positions, because that actually can cause a chain reaction where if you liquidate one thing too much at one time, you actually end up having to sell other positions to cover the original position. And it can cause like essentially a liquidity crisis within the firm where they have to actually go and then raise outside money to cover their baseline so that their investors don't sue them.
So did this happen? Is this what happened when
So this is
this
what
whole
happened
frenzy
at
happened?
Capital. They lost. Okay. So because in my prediction is that they had some of their electronic systems take over. They already had the massive short position against GameStop. They had bought puts actually on GameStop after it started getting to a certain point to reinforce that position. So it just everything just compounded into this insane mess where they had this massive leverage and also unleveraged. Effectively the whole position became leveraged because of how big the short fees were,
Mm-hmm.
and also they
So
lost
just to clarify, leverage means that they're taking a loan or like margin, right? They're like putting in more money, putting in more money.
You're putting in X amount, and you have the potential to lose more than that X.
Yeah, because just to make it clear cut, right? If for example, if you're like putting a put to say GameStop will fall, right, and the price will fall, and that price goes above the price you're predicting, you have to seep into that margin, right? So it's like, say if it goes to 150, right, and you're at 50, if it bumps to 150, you have to pay that extra 100 when it hits 150, right?
Yeah, so, minus the original price. Well, the gains that the person on the other side would make would be, because when you sell an instrument, you get the money immediately. Mm-hmm. So when you have to pay out at the end, you sort of subtract. I mean, at these levels, that level was the fixed amount that they were getting at the beginning was minuscule in comparison to the amount of money that they'd have to pay out at the end, and which is why the whole thing was just a crazy mess because they were just extremely leveraged. The short fees were massive; they were in excess of 30%. and that compounds. They had to cover their shorts, so that's extra money, which is why they lost like billions of dollars.
Oh yeah. So why do you think? I know you mentioned in the beginning you were talking about how like sometimes the retail investor might be on the wrong side of things, or might be like fighting for the wrong thing. Like, why did you suggest that?
Yeah, because like in a lot of cases, actually, like these hedge funds, they just sort of exist in the system, and yes, they do make a lot of money. They're perceived as like these like fat cats or whatever, but they are using the tools available to them. And yes, they do have like these highly advanced electronic systems that are, taking advantage of the system of like the financial system, but like they're not the ones in a lot of cases manipulating the market per se, like at large. Like, yes, there are a lot of hedge funds with like activist investors. Like David Einhorn shorted Tesla. He lost a lot of money doing that. Uh, there are very famous positions where activist investors will take short positions and lose a ton of money, but a lot of those stocks aren't actually highly correlated with like general market tendencies. Like these are sort of one-off things that are sort of outside the realm of most like people who have regular jobs or like regular retail investors.
So then in this case, how did the market like pump up so high when it happened? Like, who
So
actually
that
controls that?
So that's because GameStop, everyone knows GameStop, and it's been a meme for a while because the business model's dead. Like there's no fundamentals to support anything. So basically, you have all these people buying in, and also the stock price when people were originally started to buy in, it wasn't that high. So you had a lot of people flock in, and as the price grows over time, um, like the capital risk for the next marginal retail investor usually becomes higher and higher and higher. And what ends up happening is people buy at a higher price, at a higher price, at a higher price. But I think where a lot of people go wrong is that you're trying to screw over these hedge funds, but they're in a lot of cases they aren't the ones to blame necessarily for these like big financial meltdowns. So you're fighting you're fighting a battle, but it's not the right one, in my opinion.
So were you part of the group known as Wall Street Bets, or if you weren't, what are your
I
opinions
wasn't
on?
just because I'm not a fan of that sort of meme investing style. I think it could work. It's just in the long run,
No.
like the downside, like the expectation on the downside is so asymmetric to the
Mhm.
expectation from the upside that just over the long run, given enough sample size, I think if you sort of go about things the correct way, you'd probably be on the better side of things like almost 99% of the time, just doing stuff regularly
Oh
than
yeah.
trying to
Mhm.
find lottery tickets and doing all these crazy bets. And it's just like, it's not real investing. And I just don't think it's useful. And it's actually a lot of times it's really cavalier and irresponsible because a lot of these guys will get their friends to invest and they don't know how these things work. And what ends up happening is like in that sort of retail pool, like the meme pool or like this group pool, you actually end up selling the like instruments to each other. And within that pool, because like if they were truly acting as a hedge fund, they would put their money in together and then take it out together and distribute the losses or gains equally amongst each other. But if they were to do that, right, and there wasn't this perfect storm of short interest on the other side, the price would go back down to its original state once you pulled the money out. So you have all these people with different risk appetites pulling their money out at different points because like you have no idea like these people with like after a $10,000 gain, that's potentially life changing. So what ends up happening is you actually sell the asset within that retail pool of investors, and the capital will actually in that pool will concentrate to probably like 10 or 20% of the people, leaving 80% of those retail, like small guy investors, you're left holding the bag with nothing in it. Like you either go back down to zero or you actually lose money because you bought a bunch of call options and you can't sell them because they're now worthless because the price dropped so much below where you bought those instruments.
Yeah, because a big part of making money off of a call option or a put option is the implied volatility, right? And like how much the
Yeah.
price can go up and down. So are you saying that a lot of these people don't fully understand what they're doing? And like a lot of what investing is looking for the long term. And I think
Yeah.
that's something you're
Oh,
alluding to, right? It's better
yeah.
to just invest in the long term, watch your assets appreciate over time, add in like every so often, like for example, like that's what I do. I just like throw in a part of my paycheck every time into my investment account, and then I just watch that grow over time, because that's like really the markets go up over time for the most part, right?
Yeah.
Yeah, so we can touch on that later too a little bit actually, but the issue here is that like the pricing of these instruments is extremely intelligent. People who think they can outsmart the options market, you can just look at the volatility index, which tracks the expiration of the monthly options for the XPX. You can look at the curve and see how negative exponential it is, and outside of special case circumstances, the expected value just moves to zero at a very quick rate, and it's almost impossible to make money trying to time the market. Like people who think they can, they're either using alternative data methods and techniques that are not available to general investors, or they're using inside information, or they have like knowledge of like how the Fed works at a level that most like investors really don't understand.
You and I were like talking last night. Like, do you think these quote unquote like stock gurus on like TikToks or just in general, do you think they actually know their stuff, or they just kind of, like you said earlier, gambling, or just kind of just playing with the
So some of
momentum
them
kind of thing?
may know what they're doing, but
Mhm.
if if the techniques that they were selling actually worked, they would start their own fund and make millions and millions and millions instead of selling courses. Because a lot of times, like especially with like technical indicators and stuff like that, they only work because other people think the same as you do. Like these aren't based, like a lot of these things, number one, a lot of the indicators, they tend to reinforce themselves. Like they're not orthogonal in that they they use a lot of the same style of data to like run these calculations. So like you get these two separate technical indicators. Yes, the number values might be different and they might represent slightly different things, but like the stuff that went into them to do the calculation, there's just so much overlap that you're just really reinforcing the same thing. And they only really work if your expectation is that other people are also going to trade on this idea, and as long as you're like within the top 10% of like in terms of execution speed, you'll likely make money over time. And then the rest of like the 80, like you'll have another 10% that will break about even, and then 80% will lose money
Wow.
because they're using the same indicators and they're late to the party every time.
Yeah.
They're just not fast enough. And you're competing with computers. Like
Mhm.
people who think that they can look at charts, analyze patterns better than a computer, and then consistently beat electronic trading systems are kidding themselves.
So it's a lot of luck.
Oh, it's a hugely luck, and also
so
like how you manage information and your expectation that other people have the same, that are going to use the same information to trade.
so technical analysis, it's something I actually learned in college too. A lot of it is also like it could be a self-fulfilling prophecy, because everyone that learns it is kind of doing
Yeah,
the same
it's
thing.
using it.
Yeah.
Yeah, it's using it. And
Like
also
so,
you can
yeah.
program a computer to do it like faster than a human. And there are a lot of the reasons why like technical analysis, like electronic trading systems don't really work is because that sort of that like price discrepancy that you use to like that's calculated is usually like you actually usually get priced out already by another faster electronic trading system.
Mm-hmm.
Like it's already like the price has already been corrected, like via micro movements.
Because like a lot of bigger companies with more money have computers that actually like can correct these things, right?
Not necessarily bigger, but a lot of the most like technologically advanced hedge funds that are taking advantage of this stuff, they're using deep learning models to like learn all these patterns faster than any human for sure. And also they have a competitive advantage within the electronic trading space. Like,
so would you say majority of like retailers, they're just at a huge disadvantage already? Like just right off the bat?
Yeah, absolutely. There are people who do like there are people who can consistently make money, but part of it is luck, the experience they have within the finance space, and also like the kind of data that they are using to do the day trading, and the like how fast they are and how fast they're able to see essentially what's coming.
So then when it comes to like your investing strategy, right? What do you think is most optimal for someone, at least because we're all in the same age brackets, we're all millennials. So for the retail investor, like what do you think would be, from your perspective, the best way to invest?
So it's actually funny that you asked that because most of my work is actually on the electronic side. I'm looking at a lot of numbers and I'm trying to take advantage of sort of these like mid-cap money-making opportunities on the electronic trading side.
So what's mid
My
cap?
best friend is actually like really into like fundamental finance, like long-term capital preservation, like deep value investing. He's the one who takes care of all of the analysis on that side of things. And I'm sort of trying to slowly learn about that. But my sort of methodology is that I take his advice kind of at face value. And then also I'm trying to look for ways to sort of make money like almost in lump sums, because a lot of times like stuff that I build, you can make money consistently in relatively small amounts over a decent amount of period, and it just starts to add up over a while. But it's not a recommendation that I would make to the average person, just because number one, you need to pretty much be a software engineer. You need to know where to look in terms of data, understand how to analyze the data, and also like build and test an execution engine. It's just not work that I think a lot of people would be interested in. It's very boring for a lot of people, and it's just not something I would recommend for the general person.
But that's what works for you.
Yeah. I would recommend, however, industry research, what you think the landscape of a certain industry will look like, and then sort of try and extrapolate. You don't have to necessarily use like the traditional investment banking markers for like determining how well a company will do, but I think industry research goes a long way, and just like learning how stuff works in general is just extremely useful.
I know like certain people like told me before, like they kind of look at if like a certain CEO or board kind of like buy more shares or sell more shares, they kind of follow those trends as well. Do you think that's a good trend to follow? Or
yeah, so a useful tactic is actually just, for example, scraping Elon Musk's Twitter, and every time he tweets a ticker or a crypto, buy it and then dump it at a 5% gain. It's like very low risk. Like it's something that a lot of people can do. And as long as you're fast enough in terms of execution when you write the program, it's actually a valid tactic. A while back, like John McAfee was tweeting about various cryptos. You just scrape his Twitter feed, buy the coin, wait for a 5% pump, and then dump it. It's just, you can put like 10K in it. You make a quick $500 every time he does it.
Insane. I think Dogecoin was an example of that.
Recently.
And
today, like I think it was today actually. Yeah.
It was
Musk
also
tweeted today, right?
Musk also tweeted about it.
Yeah, Musk
Like,
also tweeted about it. So there's like stuff that you can do like that, that don't necessarily involve advanced programming techniques, but they do involve some level of programming that you can like, and you can do it, test it, see if it works, and then put it into practice if you think you might be able to execute it correctly.
so then have you like when you're basically saying a way to figure this things out, is like just test and learn, see what works for you, right?
Yeah, exactly.
Yeah, because I feel like, especially with a lot of these momentum trades, like Dogecoin, some people gambled into GameStop. I tried to gamble into GameStop. I like made some money on a day trade, and then I was totally out after like one trade. I was like, I'm done with this. I made my money. I'm out. So
You
it's
got a
like
couple
also like,
$100.
yeah, a couple $100. I'm out. It's like risk tolerances too, right? So some of these people on Wall Street bets have zero risk tolerance. Like they don't even think about it. They just go like YOLO, right?
Well, they're degenerate gamblers.
Yeah, exactly.
There's no difference between them and degenerate gamblers. They're just doing it in a more civilized way, and they're just not in Vegas.
Oh yeah. And so when it came to what you were, when your thoughts and when this thing happened, like you just kind of sat on the sidelines, watched it happen, and you understand like why it happened.
Yeah, because I mean, I've seen this movie before. Like back in 2008, the same thing happened with Volkswagen. Their car sucked at the time. The price the price was driven up like actually even more crazy than the GameStop situation. And like I saw the whole thing unfold. I knew regulators were going to step in. Like it's not that hard to predict what will happen in these situations. And I think a lot of people sort of get high on the facts like, oh yeah, we're fighting back against the big guy. But like you have to realize that like within the group of investors that you're like within that retail like small guy group, you have to realize like once the people who got in at the beginning make their money, they're going to be out.
They're going to cash out.
That capital pool is going to decrease, and you're going to have less and less power over time, and you're doomed to fail because what will happen is that the people that did make money at the beginning, they will now be in a group on the other side. And so you will destined to fail every single time. And these people will never, ever learn. And it's just hilarious to watch because it's the same type of behavior over and over and over. There's going to be like 10% of people who make money and then 90% who will either break even or lose money. And then there will be a percentage who will lose a lot of money.
Oh yeah. Like some people are still holding their calls right now. And I'm just like, what are you doing? Like that's the prime example.
Dude, I had a friend who bought GameStop yesterday, and then today it fell to $50. So it is what it is.
And things like that.
Yeah,
so
like what happens is like you end up in that pool. You actually end up selling the asset to each other. Yeah. Because you're not a single fund, so it's not consolidated capital. People are placing all these like panic market buy and sell orders, and what ends up happening is you sell the asset to each other. So you're transferring it within your own group, and it's not going anywhere. You're actually leaving your friends out to dry. So it just makes no sense. And you're just like this sort of style of investing, like this crowdsourced hedge fund style, it's just doomed to fail every single time. You just cannot compete at the level that these sophisticated electronic trading systems can compete. And you just don't have enough consolidated capital to like actually do anything.
Right. So like for those who like kind of don't invest daily or, religiously, like what exactly kind of happened last week when kind of Robinhood halted trade for a whole day? Like what was that about?
Yeah. So part of the issue there was, so Robinhood, as you guys know, is free to use. There's a saying we have in computer science as far as licensing goes. It's free as in freedom, not free as in beer, which means that, yes, everyone has maybe the right to compete or take part in a certain system, but they don't necessarily have the right to the best resources that are available in a given system. So anytime you want to move money from one side to another, that requires work. There's an inherent cost associated with it. And the expectation that you can do that for free, I think, is idiotic. There are a lot of people who want to be able to compete in that marketplace for free, but just realistically speaking, um, it's not going to work because you have to incentivize someone to do that work, and that capital injection has to come from somewhere. So in this case, Robinhood, they route a lot of their order flow to Citadel, which actually were sued earlier last year for doing because it's anti-competitive behavior. But Citadel pays for a lot of these software engineers to get paid a lot of money. Uh, you got to pay the CEO's salary. There's just like running a brokerage is this huge operation because just money management and holding money. There's just a lot of like software infrastructure costs that is associated with it. So you got to pay for it somehow. And how they do it is they route their order flow to Citadel so that Citadel can make money on either side of the trade and fund their business while also making money. Like it's an inherent. It is anti-competitive because they are routing a lot of the order flow to one place, and they might not necessarily be incentivized to give the best price or give the best execution speed. But you have to pay for the operation somehow, and how they do it is through Citadel for the most part.
Wait, so are you saying like if like let's say I'm on Robinhood and I'm selling say Tesla, like just one stock for
Yeah.
850, they actually sold it for maybe like 870 and they get the profit in between?
Well, that's like a very large bid-ask spread, but yeah, in some cases they're not incentivized to give you the best price in an asset or even execute it at the speed with which like you put in the order, for example. So you can get a larger bid-ask spread, and yeah, so you're basically getting like the B plus like range of the product essentially, but it's free. So the the routing of the order flow, yes, it's anti-competitive, but I don't necessarily agree with the fact that it's not fair because it's sort of the situation you get what you paid for.
Yeah.
I think an interesting byproduct of what happened after the whole Robinhood phenomenon is a lot of brokerages, they reduced their trading fees to basically zero. But yeah, some good came out of it, but I think like a lot of people where they go wrong is like they think you have a right to compete in something where, to be honest, in a lot of cases you have no business competing in, and if you want to compete, there's an associated cost, and then you or general investor disregarding that cost, I think is just not smart thinking.
So just to backtrack, essentially like some brokerages, right? Let's say if I'm using Fidelity or some other like place to buy stocks for my investment purposes, because I'm paying an upfront fee, that basically gives me a better premium on my like stock investment, right? Is that what you're saying? Because
Yeah,
it's more of an A grade.
You might have more access. Their software infrastructure just might be better. The bid-ask spreads might be better. The execution speed might be better. Like this is not a paid advertisement. I've been using TD for the longest time. Their bid-ask spreads are really good. Execution speed is also really good, even through their API. Like it, yeah. I mean, just because you think something should be free doesn't mean it necessarily should be free.
And there's a cost that the actual consumer doesn't see that they're paying, which is like a not as good investment
because
from the get-go.
In a normal marketplace, if you wanted to sell something, you'd have to go out and do the selling. Like no one's going to do that for free.
Yeah.
Or potentially, like if you make money on something, you get a commission. But like in this case, an entity is doing all the work for you, and then you expecting that work to be free, it's just not very smart.
Mm-hmm. So then the bid asks, right? When we're talking about that,
Yeah.
basically that means like if you're bidding for a stock to be bought, you might get a higher price or lower price depending on what is being sold at that moment, right? Just to clarify for the users that don't understand.
Yeah, so bids refer to the highest price someone is willing to pay for an asset, and the ask is basically the lowest price someone is willing to sell an asset. So that spread usually is it's large when an underlying instrument is very volatile, and it's small when an underlying instrument is very easily transactable, because the likelihood of the underlying asset price moving is small because of how easy it is to move it when you try and buy or sell it.
Mm-hmm. Exactly. And that's why some brokerages are better than others. In the cases if you want to pay more money for your transactions.
Yes.
Exactly. Okay. And just Johnson, I had a question. What was it?
I don't remember, dude.
I saw you. You were about to ask something, and I was like, "What are you
gonna
gonna ask?"
say something, but I forgot.
Oh man. But yeah, going back to we were talking about AI in the beginning of the talk, and machine learning, how that's like kind of like a buzzword, and how you don't like using it that much. Like, why is that?
Because it's just not very clear, and in a lot of cases, like when people refer to it, they mean something specific, but they use AI as just sort of this cloud buzzword term. It's more of a selling point than anything else. But like for example, like in my work, I'm working on this labeling system that's basically it's like a sequence model. Essentially, this sliding window that assigns probabilities to things, and then based on that probability, you're giving things in that window a label.
Okay.
Like, what do you mean by labeling?
Can you give that to us in layman's terms, like we're five?
Yeah. So basically, let's say you have a bunch of text. You want to find out where the names are in the text, what companies are in the text, and like what potential locations are in the text. So basically, you have this program that you have a window of some variable size. It's in some range, and then you have the sliding window that moves over the text. And as the sliding window moves across the text, you assign probabilities to each word in the window belonging to a certain label. And if it meets like some threshold, you then assign a given word probability for that label. And if the probability of a sequence of words is high enough, like in when they're consecutive, then that entire sequence then gets labeled as a certain class, whether it's like person, location, or organization, for example.
Mm-hmm.
So that method, it is probabilistic, and it's sort of referred to as AI, but it's really just a statistical model that's interpolating the data that you have available and then making a decision based on that.
So because of your machine learning engineering experience, are you able to apply this into different forms, or can this be applied to like
so
other things?
a lot of the stuff that I do in my day-to-day job, like it is applicable to different areas of science, like for example, like computational pathology, diagnosing like various diseases, computational chemistry, finance. Like there's just a lot of areas where you can do the work that I do specifically just because it's text and sequence based into other areas. Like I would say the work that I do is probably the most generally applicable because of how like almost data agnostic like the work that I'm doing is. Like it just applies to sequences in general with any sort of segmentation. So like DNA sequences, chemistry formulas, things like that. Like all of that is just like fair game.
So these algorithms can help predict. Am I using the right word? That algorithms can help predict like certain diseases that could happen based off of past factors.
Yeah. So you have this constant stream of data coming in through a machine. Let's say it's someone's blood markers, for example. you have this constant stream coming in, and then every so often the computer will reevaluate for a certain condition, and then it'll basically be able to tell you when someone's in the hospital bed, like if someone is about to like go into cardiac arrest before it actually happens, so that you can tend to them quickly, for example.
And that's
So yeah,
so where does that run? Like, how do you run that when? So, for example, like say you're sitting in a hospital bed, practically, right?
yeah.
How do they even track that with a machine learning algorithm?
So the software would be embedded into like the actual like tools that the hospital has available. So like for example, if they have a heart monitor that has a software embedded already, like the machine itself will be able to do it because like all the software is like it's basically a computer. That machine is basically a computer.
Crazy.
A lot of times these things are hooked into the cloud. So they send the data up into the cloud, and the cloud will send something back saying, "Hey, this guy's potassium levels are low. He's going to go into cardiac arrest. Please come within 15 seconds so this guy doesn't die with, in over a minute."
Wow. And so those are just some practical uses of like machine learning dash
Yeah.
AI. So for the viewers that are listening, what's the difference between artificial intelligence and machine learning? Is there a difference at all?
Um, it's the same thing. I think just when I look at it, I think the difference for me personally is machine learning is a reference to more of the classical techniques, whereas AI is sort of more of a reference to neural networks, which are sort of the new. They're not new in terms of concepts, but they're new in terms of they're new-ish in terms of like a real-world implementation.
So then what's a neural network?
A neural network basically is a modeling of how the human brain works. You're basically aggregating a bunch of data points to then come up with a generating function to then predict something. So you're interpolating between your available data points in an abstract way, which actually no one can actually verify. And then the result of the model is that you can feed in new data points and then predict some value that you were originally training for.
Interesting. So a lot of this is like very alien to most people that are not in your field, right? So if you were to like, what's your like biggest prediction though for like this field that you're in right now? Because I'm just curious to see like where else it could apply. Like, what's the future for this stuff? Because I know in advertising where I work, we use AI to predict certain audiences and target people.
Yeah. So customer segmentation is a big part of like sort of the consumer side of things. Like for example, if you're working at a credit card company, like predicting whether someone is like a high net worth individual, like what kind of credit limit to give them, things like that, all comes under like this like field of segmentation.
And so is that something that you see becoming even more granular in the future? Like, how do you think this is going to progress?
Yeah. Like the amount of data that's being used to do that stuff is like insane. Like you have like people collecting social credit to determine actual credit. Like for example, they say, you're the average of your 5 best friends or whatever. Like that's actually becoming a reality. Like they're using data from your peers to actually predict the likelihood that you might pay off your next billing cycle, for example.
So social credit is basically they're looking at like your social networks within like social media, and then they're like,
your social media data, what kind of things you browse, like all that data is being fed into these like generalized prediction techniques to then be able to say, is this person likely to do this? Is this person likely to do this? And sort of to predict a lot of aspects of your life.
Mm-hmm. There was like an app in
China. That's going to take over like credit score? Oh shit, my
bad. What?
Wait, ask your question first. I'll cut it out. Ask your question first.
No, I was just gonna ask, like, do you think that's gonna be predominantly the way, like, let's say, creditors gonna see people, as in like these social credits over like a regular credit score, or do you think?
Well, it's both, right?
Mhm.
But before they would analyze your ability to pay back a loan, for example, just by you. Like it was just
Yeah.
you and your data. But now it might be a better predictor to see what your friends are doing and how likely they are to pay their loans back, to see if it might give you uh, to 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 assign you this a similar value. Because the idea is that you tend to hang out with them, you sort of the groupthink mentality. So it might actually be a better predictor to see what your friends are doing than to see what you're doing.
That's pretty cool.
What is this called? Like, what is there a company doing this right now?
Yeah, Experian does it.
Experian
They
does
have
this.
Oh shoot.
they have access to like unfathomable amounts of data that you aren't aware that they have.
So they know like I'm hanging out with Gio and like all our roommates,
Oh
and
yeah,
they
for
can
sure.
just.
Oh
That's
yeah,
crazy.
dude, Johnson, this is my job too. Like we actually use experience data to target people in the finance sectors, like for example, like credit cards and
Shit.
stuff, because they know like demographic, age, location, sectors of working. Like it's crazy, like the amount of things you can target with Experian in an advertising setting. And people consent to it. They just also have like companies like LiveRamp where you can like anonymize data by uploading it into there, and then it anonymizes like a whole set of emails, and then can match those emails to someone's like addresses and like that long, and then they'll like target you that way with an ad too. And machine learning also helps with like stuff like that too. It's a really big kerfuffle of this stuff, and it like wrecks me. Um, yeah, I like it's a good thing like you brought it up because it's just crazy to see like where machine learning has taken the world, and a lot of people aren't even aware of it.
Well, I mean, it sort of circles back to what I was saying before. Like a lot of the stuff that is the result of these things isn't exactly verifiable by the people who built the tools either. Like a lot of these models, they're not queryable, and they're not like you can't see like how they're working necessarily. In a lot of cases with neural networks, you could just see what you put in and what comes out of it. Like you're not able to see like how it's doing it. You're not able to look at the features that it has extracted beyond what you've inserted into the model. And I think
Mhm.
that's where it's that's sort of where the next stage of machine learning is going, is actually being able to query a model and to see how something is being produced rather than what it is producing.
So you don't see like the actual thought process the machine goes through to get
Yeah,
to X point. So
it's
basically,
just a black box. It's a
yeah.
black
So
box, right?
you put something in, and then it just comes out, and then that's it.
Yeah. You train it, it becomes this black box of code sitting on a server somewhere. You send it data, it spits something out. It's like, oh wow, that's actually right, and then you just move on with your life.
So then, has there been situations where things have gone so wrong with these like algorithms?
Oh yeah,
Like,
yeah, yeah, absolutely. Like I said before too, like they confirm a lot of biases in ways that aren't necessarily good, especially on the social side of things. Um, yeah, there's a lot of like ethics related consequences that comes out of these things because of how fast they learn the biases too, and because you're targeted in such a way where you're pretty much at the mercy of these things. Like now you have a lot of these kids that are observing websites and being targeted with ads. You could And because of like how young people are and like what they're using, like it can be very formative for them. So you feeding them this very subversive data can actually be very dangerous to a child's developmental health. And I think we're going to start to see a lot of the consequences of this in sort of this next probably two generations below me, because you look at social media and you look at the not to get like too dark, but like suicide rates amongst
Yeah.
girls, especially during the teenage years, and like with guys, like it's just it'll be interesting to see what the developmental cycle of a kid is going to look like in a few years, especially when they're being fed all these like biased data from looking at ads, like you know, like that one kid who opens the toys on YouTube. He's like,
Yes.
I don't know, like he's like he makes
When he
like
makes
$40 million
$20
a year.
Yeah.
He makes a
And
lot of money.
Yeah, and his channel is basically one giant ad. And like, yeah, it's crazy.
Because
So would you say like
we do have restrictions
go
on ads. Sorry, I just need to put this in. We do have
Yeah.
restrictions on ads for people when you serve to them. But
Yeah.
I don't know what happened because I know Facebook has age restrictions too. But it
Yeah.
doesn't seem like these things are working because they always just bypass this by lying about their age.
But also the thing is like no matter what it is, right? And especially if you're young, if you're like 2, 3 years old, and you're like anything you look at can have an imprint on your brain. Like those are the most important years of like child development, or just development in general, because they impact the rest of your life. And I think it's extremely important for parents to like supervise it instead of saying, hey, stop crying, here's an iPad, go do whatever. Like there's a lot of downstream consequences for especially kids, what they look at, what they learn and stuff like that. And it's just I think we're going to start to see the manifestation of these things like pretty soon. And it might be good and also might be bad.
So you were talking about machine learning, like I feel like, or would you agree that like machine learning is going to kind of make the rich get richer, and then the people who are kind of like us, or like people who are in unfortunate situations, or like these kids in the future generation, they'll probably be affected the most?
Well, I mean, access to information does that in general. And if you have access to information and you're developing things to be able to act on that data even faster, yeah, it's going to widen the gap for sure. Because in a lot of cases, like I was telling Gio earlier, I guess it was last week during the whole GameStop thing, the more repeatable your job is, the more examples there are for a computer to learn to be able to do it better than you can. So like if your day-to-day work is extremely repetitive, chances are you're just feeding a computer potential data to be able to learn to do it
Faster,
better than you.
Better. Damn.
I mean, you work
Like,
in
if
real
you're-
estate, Johnson. So like, do you think you can get replaced by a computer? Like, what do you think?
I mean, I feel like eventually, right? But I feel like humans still want that human touch of meeting someone, going through the contracts, making sure that everything's correct, instead of just like listening to a computer and not having that human touch. That's what I think. But I think eventually, like real estate might be, down the road, more computerized and everything as well.
A lot of it will get automated, but also a home is just so personal that I feel like if you don't have a person on the other side sort of mediating that sale, it probably feels a bit weird to the buyer. So I think, we'll see what the state of home ownership will look like in a couple of years or whatever, because there's talks of like all the homes just being modular, where it's like, hey, you want to move? You basically trailer parks. It's like a very modernized, like tech infused like trailer park home essentially, where it's like, hey, you want to move? All right, attach your home to the back of your truck and then move cross country or whatever.
Shit, I did not hear about that. Holy shit.
Yeah, there's like modular smart homes or whatever. That is like the new way. Like, yeah, I mean, it's it'll be interesting.
Let's see.
Yeah, no, we were just like thinking about like the future of things and how technology just moves so quick. Like Carvana. Have you seen ads for Carvana?
No.
Carvana is basically like this app where you can download you download the app and then you can put your car up on the app and they pick up the car for you and then sell it for you and then they drop it off to the buyer. and then they have like vending machines of cars that can like sell cars for you. It's like
Is
that.
this in Japan?
No, this is in the U.S.
Oh, in the US. Oh,
This is in the U.S. So
Yeah, it already exists. Yeah.
it exists like in the. I've seen ads on Hulu for this, and it's crazy how that might become like something that real estate might try to do. I know, like, what was it? Like they might try to like move it in that direction where like you don't have to
Yeah.
talk to a person, but like as you said, home owning is so personal, and you need a personal touch to that, right? It's not
Yeah.
possible to just sell your house and not have a person help you sell your house.
Cars.
You also
actually,
don't want to spend $1 million
Yeah,
without
exactly.
like a human touch to it.
Cars are actually the one thing where I like car salesmen have such a bad reputation. Also, they are like there's a reason why they have a bad reputation is because they actually are that bad. And like car salesmen, I think are the one area where you can remove them and it'd just be completely fine. Because like when you go to buy a car, you already 99% you already know what you want. And then you're spending so much time there with the guy trying to upsell you, just feeding you all this BS nonsense as to why you should get like a better car. It's just like I like the idea of vending machine, just give me the car and be on my way.
No, I remember.
Bank loan and then be on my way.
No, I remember 3, 4 years ago when I moved back to California for a little bit, and my parents were trying to help me, rent a car because for my work I do real estate, and we were trying to get a new car so I can take clients around, and they literally spent like 8 hours just trying to talk to this sales guy to get the price down by a couple hundred, a couple thousand, and that was just a waste of time.
Yeah. At that point, your time is worth more
More valuable than that.
What what?
Yeah.
Okay, that's
I remember we got
when you drive the car off the lot, you lost 40%. So even if you got the price down by 2,000, like 800 of it is gone immediately. Like you're down to like 1,200, and at that point, like at that point you're just pinching pennies there.
Yeah.
Not that $1,200 isn't a lot of money to a lot of people, but at some point your time has to be worth more than
What are you putting in?
worth more than that.
Yeah, and we're learning that the time value of money is something that'll like help you get like richer if you just like hold on to your money, right? Like investing for the long term is basically a better strategy than gambling like these Wall Street bettors. And like we're almost at time, by the way, so I just want to like ask if you have any last words.
Last words? No.
Or like for example, what do you think is your biggest advice to the people listening right now?
I think what's the most applicable, especially given the circumstances today, is honestly just do whatever you want to do and don't do what you don't want to do unless it's to your detriment. Obviously there's some stuff that has to be done and you have your, civic duties as a society member, but honestly, really just do what you want to do. And then don't do stuff you don't want to do. It's just that simple.
Make the options for yourself is what you're saying.
Yeah.
Which is something that not a lot of people do. But yeah, man. Thank you so much for coming on to the show. It was really good talking to you. It was like very insightful to learn about machine learning, AI, GME, Wall Street bets, how degenerate these bets are. Like I read Wall Street bets a lot, and I'm just learning like, yeah, this is not how you should be investing your time and your money because eventually you're going to lose and it doesn't work.
Yeah, if you make 50-50 bets repeatedly, your expected return is zero.
Take that away.
They invested. They should know that.
That was the sum of the right there. Oh
Yep.
man. Okay, wait. I'm gonna cut the recording 1 sec.